Hello guys, how are you doing? Welcome to lecture 3. And today we're going to talk about the 5 categories of the accounting. And we're gonna go deep a little bit to see how they reflect on the financial statements and examples, and we'll give an examples for each. Actually, today we have a little bit fun, although we have lots of examples to do. So stay ahead and try to focus with me. If you can open a Word document or bring a paper, maybe anything that will help you to write your notes and stay focused. Okay, let's start. Let's start up. Okay. So we are beginning. That's the assets. We're going to talk about assets now. So, as we said, what is the assets exactly? Assets is resources owned by business and provide future benefits. Like in the previous lecture, we give an example about the car, the Uber driving. We said how we differentiate assets from expenses. Like we need a cab, so we ordered Uber driving and we paid money. That's called an expenses. And if we bought the car, that means that this car will benefit our company organization in the long term, and so that's called an asset. But getting deep, we have two types of assets. There is a long-term asset and there is a short-term asset. Okay, let's go deeper. What's long-term asset? It's also called non-current assets. Okay, which is more than 1 year. It could benefit your organization for more than 1 year. And for example, we have like a PPE. What's a PPE? It's a property, plants and equipment. That's a term that's well known in the accounting industry, a PPE. It's really known for non-current assets. Okay, for example, we have the land, building, equipment. What's the equipment? It's machines, computers, furniture. We have the cars or trucks. Okay, so those are the long-term assets, which means I will benefit for it will give me a benefit for more than 1 year. All right. On the contrary, we have a short-term assets. It's called a current asset. It's benefits for less than 1 year. For example, a cash. Cash is available money in the company's treasury or in its bank account. Cash is available right now. It's something I can pay with it in this time frame, not in the long run. I don't know what's going to happen in the long term. But for now, as a short term, I have the cash right now. Alright? The account receivable, as we said, anything called receivable is an asset and anything is called payable is an expense. So we have the account receivable. That means, okay, let's try to get a storytelling about the account receivable and the notes receivable in order to understand more. So now a customer, a friend of mine or a customer, a known customer, gave me a call and told me, "Hey, how are you doing?" I said, "Hi, how everything's going?" He said, I need to purchase 5 TV right now, but I won't pay now. Please put it on the account. Put it on my account." Alright, so I gave him the 5 TVs he ordered from me and I didn't take the money. Instead, I added him to the account receivable. which is an account, and have like a subclass of it, the names of the customers who purchased but not yet paid. Okay, that's an account receivable. Notes receivable, I need like a note that you have a sign on it that says that you're going to pay that money in a specific time. Alright, so account receivable, notes receivable, supplies. Supplies like pens, papers, trash can, laptops, maybe, yeah, it's a supplies. Okay, it's a supplies. Inventory. So let's say if we have like if we have like a TV and laptop shop, okay, and we don't have any more supplies. So I go to the warehouse where the inventory is. So what's the inventory? It's a goods not sold stored in the warehouse. Alright? So that's called an inventory. Prepaid expenses. Expenses paid in advance. Like rent. Okay, rent is an expense. But what if I told the owner that I need that apartment for 1 year and I paid him the 1 year in advance? Okay, so now it's turned to be an asset because I will benefit from this apartment for a period of time which is less than 1 year in that case. Alright, so what you have to do is memorize this. It's very easy to do. Assets are two types. There are two types of assets, subclasses, okay, subdivision of assets. The current assets, which is the long term, the current assets, which is the short term, and non-current assets, which is long term. Long term more than 1 year, short term less than 1 year. For the non-current assets, we have the PPE, the plant, the property, plant, equipment. That's well-known term for accounting, PPE. So we have the land, the building, the equipment. We have the cars, trucks, okay? And for the short-term assets, anything which is payable, which is account payable, notes payable, supplies, inventory, prepaid, expense. Okay, so let's check what will happen if a change in that category or in that account happened. What will happen? How it's going to affect the financial statements. So, for example, land, building, equipment, cars, trucks, supplies, inventory increase by purchasing and decrease by selling. So, right? If I bought new cars, I bought new trucks, that means it's increasing. The land is increasing, the building is increasing, equipment is increasing too, and it decreases eventually by selling. The cash increase by collecting or receiving money in cash or by check. Decrease by paying money in cash or by check. That's pretty awesome. Account receivable increase by billing customer, performing service rendered, selling assets on account or on credit. Decrease by collecting money from customers. Okay, let's head to AR. So account receivable, I said that the customer ordered 5 TVs and he said, put it on the account for it. Put in the account. I will give you the money in a period of time. Alright. How I'm going to take that money? How it's going to increase? If I took that money, AR increase, which means if I took that money from him, that means this account or this customer is no longer in the AR. Is no longer. He already paid me. I gave him the products and he already paid me. So the account receivable is decreasing. It's not increasing. So it's decreasing by collecting the money from him. But what if he started to order again, and another customer started to order again. And the same way applies. Fuad give us laptops and we will pay you on account. Okay, that means it increased how? By billing customers, by performing a service. So by giving him an actual product or just giving him a service and yet he didn't pay. Service rendered is the same as performing service. Selling an asset on account or on a credit. It's like giving him a product. NR is notes receivable like an AR but with a written paper, as we said. Prepaid expenses increases when paying expense in advance. Decrease when consuming it. Like giving the example before, the apartment. If I give the owner a 6 month in advance and I used 4 months, out of the 6 months, that means that it's decreasing, right? The prepaid expense account is decreasing. How do you measure assets? By their costs or fair market value? Okay, let's hit and ask that question. So if I have a car right now, I bought it for 100 grand, okay? And its fair market value right now is just an 80. So should I write 80 in the financial statement or write the 100 grand that I bought it? What do you think, guys? What do you think about that? Yeah, give me your opinions. I'm hearing you all. I will give you like 10 seconds to let me know. What do you think about it? Okay, I hear some of you say the fair market value seems to be more realistic, and the others say that we need to write the actual figure or the actual value. All right. Okay, let's see. What should we do, and what is the best appropriate way to write it? Okay. So we have two things that we should focus on. Whereas the cost and the market fair value is different. Okay, the cost is actual cost that I bought the car. Okay, it's objective, it's reliability and verifiability, which means objective, which means it has an invoice. I already have a paper that says that I bought this car for 100 grand. Market fair value is subjective, which means if I go to that trader, he will tell me it's only worth 75,000 grand, and the other is telling me 60,000 is only. It's a lot, man. It's already used, you know. So it's subjective. So there's nothing that says that this car is for X amount. Okay, it's always subjective because it's a used car, and they don't have a paper that says that, you know. Relevant, yeah, it's more relevant, of course, because it's the market value right now, but it's non-verifiability. There is non-verifiability. So what should I do? We actually write the actual cost in the financial statement, but we add the fair market value in the related disclosure, as we have seen in the first lecture. Okay, you can review my first lecture and you will find how did I do this, how did I do that related disclosure. Okay, so we write the actual cost, and in the notes section or in the related disclosure section we write the actual fair market value for this car is X amount. You can kindly read this if you want. Oh, let's head to liabilities. Liabilities doesn't have two categories like the assets was. I'm going to give you an example for liabilities in order to understand. Okay, liabilities is anything related to payable. Okay, which means if my company purchased goods from other company, and yet we didn't pay them. Okay, that means we we now account payable. We have to pay them. Payable is paying. Account payable. Okay, so we have to pay this organization. Account payable, money you owed to other and not paid yet, resulting from purchasing asset on account or using a service. Okay, EP is expense payable. That's for getting a service. And notes payable, money you owed to other and not paid yet and proven with paper. With paper. Okay. Loan is money borrowed from a bank. Unearned revenue, amount collected in advance and services to be performed in the future. Let's give an example about unearned revenue. Okay, so I'm owning a travel agency. Okay, while a customer came in and told me after 5 months I would like to go to Spain. I told him that traveling to Spain will cost you around 50 grand. He said okay, alright, and he paid me the 50 grand in advance. So that's called the unearned revenue. So I took the money and I still didn't do the service. Alright, I still didn't do the service. The service will be done after 8 months. That means unearned revenue. Amount collected in advance for services to be performed in the future. Change in liabilities. Okay. Account payable. What's going to increase the account payable? It's simple. If I used more, if I purchased more goods, that will increase the accounts payable. And if I simply paid the amount, this will decrease the AP. The AP and EP, of course. The notes payable, it's a written paper. So there's an obligation, The loan increase when getting another loans from banks and decreases by paying the amount to the bank. Unearned revenue increases when I take more money from the clients and decreases by performing the service in time. Okay? On account, on credit means AR or AP or EP, which means we have seen like notes payable, notes receivable, on account, on credit, right? Okay. So if he said put it on the account, will it be account payable or account receivable? Okay. And the same for credit. On account means on credit. Okay. So if the company does a service or sell asset to customers, so it's an AR. If I purchased it, so I will have to pay it, which means account payable. But if I'm the company and someone from outside, like a customer, bought from me a product, that means I will have to receive the amount, which is called the account receivable. I will have to receive the money. How will I receive the money? Through cash or on account or through notes, anything. Alright? That's called receivables. Owner's equity. The owner's investment in the company consists from only one account, which is capital. How we increase capital? Through two things. Only two things. Through revenue and through further investments. Okay? So investments and revenue are the only two ways to increase the capital. Alright. How it can be described? It can be described as the ownership claim on total assets, residual equities. What is residual equities? Okay, imagine that we are liquidating the company, alright? And we have a little amount of money actually after liquidation. So the residual equities is the money that exists after liquidating, and it's mainly or primary a small amount of money. Okay, so why that's called the residual? So the residual amount, who will I pay it for? Will I take it or will I pay it to the partnerships and the liability that I have? So he said that in terms of accounting, we pay that money for strangers first. Okay, so we pay the partnerships, we pay the liabilities first, and then if a money is still, if there's still money after paying them, I am as the owner will take it. Okay, so that's the residual equities. If the company is going to close in its life and there is a little cash available, the priority of payment is to the creditors, and the rest goes to the owners. Delta is a change, as we said in mathematics, delta in owner's equity. Alright, let's say this. Let's see it. Okay. Let's break it down. Here is a breaking down. Let's break it down. We have let me just increase the font so you can read. Still bad. Yeah. Okay. We have a capital beginning and we have a capital ending, right? What is the capital beginning? I'm sorry, I'm trying to. This laptop is new. I don't know. It's new for me. Okay. How can we get the capital beginning? The capital beginning is simply, the first thing is we are going to do is we're going to figure out the income statement, which is revenue minus expenses, and we will have a net income or net loss. Let's suppose that we have a net income. Okay. After this, we have the capital beginning, and we have another way to get it. We still didn't get the capital beginning. The capital beginning here in that example will be mentioned, but if you want to get the capital, it's assets minus liabilities will be equal to owner's equity, which means capital beginning or capital. It will be capital beginning if the example says that it's giving the date on the first of the year. All right, perfectly. So, in other terms, when we get the capital beginning, what we will do to get the capital ending? We have the capital beginning and we will have the net income and equal to the capital ending, right? Let's break down the net income, please. So the net income, we have revenue minus expenses. Okay, let's break it down. Let's remove net income and write revenue, and let's write expenses. Minus expense, revenue minus expenses. Okay. What if I have, we said that revenues will bring up the capital, and also we said investment. So why not we can write investment? So capital beginning plus investment plus revenue minus expenses. What else can lead to decrease the owner equity? It's called the D, drawings minus drawings, where the owner draws money from the company. Okay, so capital beginning plus investment plus revenue minus expenses minus drawings, the two factors that lead to the gross of the capital, plus the other two factors or accounts that lead to capital decreasing, will be equal to capital ending. So that's a breakdown. Alright, perfect. Let's write it into an equation then. Capital ending equal to capital beginning plus investment if exists plus plus revenues plus minus expenses minus drawings, and that's it. Alright, we have a delta, we have a change. So how can we monitor the change? What's the change happened between the capital beginning and the capital ending? Let's say, for example, we have a capital beginning for 100,000, and we have a capital ending for 120,000. Okay, how can I know the change? I want to know the change, what happened, what are the changes happened. Okay, so delta, we will use the delta. So that equation is to determine the change that occurs in the owner's equity or in the capital beginning and capital ending. So change in owner's equity will be equal to change in capital will be equal to change in capital ending minus change in capital beginning. Okay, let's put into action, please. So it's equal to capital ending 120,000 minus 100,000 will be equal to 20,000. So that's the change. The third equation we have is capital ending minus capital beginning equal. Okay, and we can get it by here. Capital ending, if we moved the capital beginning to this side, it would be capital ending. If we moved this is a positive, right? Capital beginning in positive. If we removed it and put it in the other side, we will have to put it in the other sign, which is the negative sign. So capital ending minus capital beginning equal plus investment plus revenues expenses drawings. We call this red. These three are called red because if we take the first letter, revenues R, expenses E, drawings D, so RED is red, and we add the investment if it's mentioned. So capital ending minus capital beginning equal plus investment plus revenues minus expenses minus drawings. Alright, that's all. As we can see, owner's equity ending equal owner's equity beginning plus additional investment plus red, or minus E minus D. Let's get started. To solve some of the equations. Okay, you have to open up. Alright. Okay. Yes, a company began. Let's see, this is number one. Okay. Perfect. Okay. Yes, a company began the year with owner's equity of 50. That's right. Okay. Yes, a company began the year with owner's equity of 15,000. That means the capital beginning equal 15,000. Alright, that's perfect. Yes, the company received additional owner investment of 21,000, which means investment equal 15,000. Perfect. Recorded revenues of 74,000. Revenues equal 74,000. Perfect. Expenses 60,000. Expenses, I'm just writing what it says. 64,000. Perfect. I'm sorry, expense for 60 only. 60. My mistake. And had owner drawings of 4,000. Drawings equal 4,000. What was Yasser's ending owner's equity? So I need the capital ending missing. That's the missing part. Okay, let's solve it. It's easy. I have the capital beginning, I have investment, I have revenue, I have expenses, I have drawings. Okay, let's go ahead. The capital ending equal, sorry, the font is getting, okay, let's solve it. So let's type in our equation, which is capital beginning. This laptop is making me crazy. Alright, capital beginning equal equal investment. I have investment. I have revenues minus expenses. I have expenses minus drawings. Okay, let's write the numbers. Capital beginning is 15,000 equal investment. Capital beginning is 15,000. Investment is 15,000 also. Let's double check this, please. No, additional owner investment of 21,000. Okay, that's my bad. 21,000 plus revenues 74,000 minus expenses 60,000 minus drawings 4,000. Perfect. Equal. Let's go. Okay, 21,000. Okay, 21,000 plus 74,000 is for 95,000. So we have here 95,000. 95,000. Let's say 90 minus 60. It's 35. Now it's 35 minus 4. It's 31. So it's just for 31. I'm sorry. This is being too capital ending. I'm sorry. It's too bad. Capital ending. Why I wrote this? Capital ending. It's not a capital beginning. My bad. Capital ending. Yeah. As we said, that's 95. And 95 minus 60 would be 35. 35 minus 4, which means 31. Oh, my bad. Let's try to calculate it, please. Double check. You have to double check your answers. Yes, the company began the year with owner's equity of 15,000 during the year. Received additional owner investment of 21,000. Recorded revenues of 74,000. Expense of 16. Had owner drawings and what was the IS's ending owner's equity. Okay. Okay, let's try to solve it by other means, please. Alright. Let's try to solve it by other means. Okay, let's use the owner's equity statement. So capital beginning is for 15,000 plus investment 21,000 plus revenues 74,000 minus expenses 60,000 minus drawings 4,000. Let's check it. Plus 15,000 64 46,000 46. Yeah, 46. The answer is number D. Okay. Number 2, our company began the year with owner's equity of 15,000. Owner's equity of 15,000, okay. Received additional owner investment of 20. I was solving wrong. I was solving another one. No, it's the same. Code expense of 60. Okay, it's same numbers. Yeah. And had owner drawings of 4,000. Okay, the farm's ending owner's equity was 46,000. 46,000. Okay. What was the company's revenue? Alright, let's go and solve it. Okay. I have here the capital ending, I have the capital beginning. Okay. Capital ending minus capital beginning. 46,000 minus can you remember the equation or not? We can say it, yeah. I've wrote it here. Capital beginning plus REID equal capital ending. Okay. Capital ending minus capital beginning equal. Okay, let's try to do it. Capital ending is for 46,000 minus capital beginning is for 15,000 equal investment 21,000, revenue I don't know, plus op minus expenses 60,000 minus drawings 4,000. Let's simplify. So 31,000 equal 21,000 plus R minus 64,000. So 31,000 minus 21,000 plus 64,000 equal org. 31,000 minus 21,000 plus 64,000 will be equal to 74,000. So org equal 74,000. The answer is 74,000. Number 3, Mustafa company began the year with owner's equity of 175,000. Okay. During the year, the company recorded revenues of 250,000. So revenues 250,000. Expenses 190. Okay. What else do we have? Drawings 20,000. What? Drawings 20,000. Okay, investments 21. Capital ending. Do we have an investment? What was of owner's equity at the end of the year? We do not have any investments, not even. Okay. Capital ending. We do not have capital ending. What was Mustafa owner's equity at the end of the year? Okay. Alright. Capital beginning, revenues, expenses, drawings. That's a red. It's very easy, straightforward. Okay, 175. Capital ending equal capital ending equal capital beginning, which is 175,000 plus org 250,000 minus red minus ed 190,000 and 210. Okay. Plus 250,000. Sorry. 175 plus 250,000 minus 210,000 equal 215. So the capital ending here is for 215,000 pounds. Okay. So number 4 and number 5 is like practical examples for you guys to do. I solved the first 3 parts, the first 3 examples, and you have to take assignment as number 4 and number 5. Okay, let's move. Use the following information, questions 1 and 2. Okay, let's check it. Mustafa service shop started the year with total assets of 100,000 and total liabilities of 80,000. Okay, that's 2. Use the following information, questions 3 and 5. Alright. Okay, let's start solving these examples. Okay, let's solve. Mustafa Service Shop started the year with total assets of 100,000. So total assets 100,000. Okay. Total liabilities 80,000. Total liabilities 80,000, and he mentioned that it's for the beginning of the year. During the year, the business recorded 210 in revenues. Okay, 210 in revenues. So revenues 210. 110 expenses. 110. And owner drawings of 20,000. Drawings 20,000. I don't have the owners, I don't have the capital beginning, so I can get it simply by this equation. Assets minus liabilities equal to owner's equity, and that's we're gonna change numbers. Assets for 100,000 minus 80,000, which means 20,000. So the owner's equity is for 20,000. Okay, that's the capital beginning. Okay, what do you want? Owner's equity at the end of the year was, I need the capital ending, and I can get easily. I have revenue, expenses, drawings, VAT. I have the VAT. So 20,000 plus 210 is 230. 230 minus 110. Let's say 230 minus 100, which is 130. 120. 120 minus 20. 100. So the capital ending is 100. Okay, I hope you guys are following up my thinking. The net income reported by Sarah's service shop for the year was, so I want to get the net income. Net income is revenue minus expenses. Revenue is 210, expense 110, 210, 110, which means 100. So I will go with 100. Use the following information for question 3 to 5. Ahmed consulted started liabilities with total assets, total liabilities during business recorded 8,000. Owner's equity, the same. This is the same as the previous example, so you guys, you can solve it alone. Okay, let's check this. Use the following information for questions 6 to 8. Arm's computer repair shop started the year with total assets of 270,000, total liabilities. Okay, Arm's capital balance, the net income, the capital balance changed. Liabilities of the company would not include. Okay, let's try to solve this. Okay, it's the same as the previous one. Arm's computer started the year with total assets 270. Okay, 270,000. Total liabilities of 180. The business recorded 450,000 revenues. 450,000. Okay, perfect. And 255 in expenses. 255 for expenses. And withdraw 45,000. Withdraw 45,000. Do not have the capital beginning yet. So let's get the capital beginning. Total assets minus liabilities 270. Let's say that's 170. That's 100. That's 90. So the capital beginning is 90,000 pounds. Okay, that's the capital beginning. think. Okay, let's get the capital balance at the end of the year. So £90,000 plus revenues 450,000 plus 100, that's 550, so that's 540. 540 minus 40 will be, sorry, I cannot keep it up, my brain is dying. Okay, let's try to do it by calculator, please. Feel a little bit sleepy. Okay, so 90,000, okay, capital beginning plus a revenue 45 minus expenses minus drawings 240. So the capital ending is 240. Alright, perfect. The net income, revenues minus expenses, let's say 450 minus 200 is 250, 200, 195. Okay, so Amr's capital, the net income 195. Alright, Amr's capital balance is changed in what amount? Okay, that's the delta. That change, capital ending minus capital beginning. Capital ending was 240, 200 delta. Okay, have to, yeah, delta capital, yeah, that's it. Delta capital ending minus capital beginning. Okay, so delta capital ending is 240 minus capital beginning is 90. 240,000 minus 90, $150,000 positive. We'll go with D. Okay, let's continue, please. Alright, liabilities of a company would not include. Liabilities is anything includes payable. Alright, so that's why it's a liability, we have to pay it. Notes payable, account payable, wages payable, it's all payable, it's all liabilities, cash. I will go with cash. That's an asset. Actually, it's current asset, short-term asset. Owner's equity can be described as, okay, creditors claim on total assets, no way. Benefactors claim on total assets, no way. Ownership claim on total assets, I would go with this one, B. Number 11, owner's equity is best depicted by the following. Okay, owner's equity. Assets, owner's equity, how can we get it? Assets minus liabilities equal owner's equity. Okay. Assets minus liabilities. Perfect. Capital is an owner permanent investment in the business equal to assets minus owner's equity. Assets minus owner's equity. What is this? Equal to liabilities minus owner equity equal to. I will go with the first one, an owner's permanent investment in the business. Number 13, sources of increases to owner's equity are, yeah, we said that there are two types that increases the capital, which is investment and revenue. So I will go with revenue. Owner's equity is decreased by assets, revenue, expenses, liabilities. I would go with expenses. When an owner withdraws cash or other assets from a business for personal use, these withdrawals are termed as drawings, of course. Yeah. We don't know what's depletion, we don't know what's consumptions, we just know about drawings. If an owner makes a withdrawal of cash from a proprietorship, then there has been a violation of accounting principles. No, owner's equity will decrease, of course. Of course. he already withdraw. I will go with C. Owner's capital at the end of the period is equal to OE beginning plus net income minus liabilities. Liabilities? What the heck? OE beginning plus net income minus drawings. Yeah, I will go with that one. So that's for today. I hope you enjoyed the video. That's the solution manual. Okay. We solved everything. I hope you do your homework and let me know if you have any questions in the comments below. Just comment and tell me, do you want anything else from this? Do you want me to explain something in further? Do you have any questions? And let me know your answers for the questions I gave you as an homework. Okay guys, I enjoyed really this lecture with you. This is a very good lecture. We had lots of drama. So I see you guys in the next lecture. Bye bye.